Okay. So again, I'm pleased to call this Sinking Fund Commission meeting to order. First item on the agenda is the approval of the November 2021 minutes. Is there a motion?
I will make a motion.
Motion is made. Is there a second?
Yes, sir.
All right. Motion has been made and properly seconded. All those in favor say aye.
Aye.
Aye. Okay. That motion has passed. The second item on the agenda is the asset allocation review and update. This is a topic that's a carryover from our last meeting. So I'm going to turn it over to Christopher, who will make the necessary introductions.
Thanks, Don, and good morning, everyone. I'll keep my comments brief. As Don said, this is a continuation of a discussion from the last meeting. You'll recall that the changes to the most recent changes to the asset allocation were approved back in late 2019. That's when the investment policy statement was updated. We've gone through as a staff and a board a couple of reviews of this. I think there's been a lot of good questions around some of the topics. You'll see, listed on the agenda, and that list isn't intended to be exhaustive or require any votes, but some of the issues that, have been brought to the table, what should we do with private debt? How do private assets more broadly fit into the asset allocation? There's an open RFP for large cap domestic equity. And I think there's some other, related topics. You should have a very recent updated asset allocation modeling package from PFM. And with that, I'll turn it over to Alex, Surya, and the rest of the PFM team to walk through their slides and take questions from the commissioners.
Sure. Thanks, Chris. And you just want us to go through this in the order that it's in the presentation, or that the order that it's in the agenda?
No, I think the way you have it laid out in the package is fine.
Yeah, because we are, like Chris said, we're focused on a number of issues. At the end of the day, they all are connected, but they're fairly distinct in their nature. In general, as Chris said, this is in response to just a number of questions and discussions that we've had at the last few meetings. Certainly, I think since Fran came on board, we wanted to rightly revisit some decisions that were made 2 years ago, but not implemented yet. As you know, we've been engaged this year in a search for private debt. We've reviewed some managers, but it was that final step before commitment that we decided to take a look back. You all know Surya Pisapati, member of our investment committee, head of domestic equity research. We're also joined today by Alex Gurvich. He is our director of research, member of our investment committee. He joined PFM about 4 years ago from the Common Fund and has a background in alternative assets. He's mostly going to be observing. He just wants to kind of see where the discussion heads so that he can better direct the research team, etc. But he may chime in with a statement or two here and there, depending on where the conversation goes. I did receive some questions from Chris, ahead of the meeting related to this. So I will try to address those questions as we go along, I suppose. But let's flip ahead. The next slide and one after this. So the underpinning, this is a Monte Carlo simulation. We've done this in the past. The underpinning of it all are the PFM capital market assumptions that we prepare. Our investment committee prepares them every year. They're done in 2 sets, intermediate and long term. The intermediate is designed to be, as you can see there, a 5-year projection. It takes into account current market conditions much more heavily than the long-term projections, which we view as a 30-year plus horizon. These change every year. I think, and we've done, subsequent to the 2019 asset allocation, after which, the IPS was improved, we did, as we continued to look at, implementing that asset allocation, we reviewed updates to this over the last 2 years as well, under the 2020 and 2021 CMAs, which I think was reviewed most recently at the beginning of 2021. But anyhow, high level between 2019 and now, some of the major differences in these capital market assumptions, particularly over the long term, are around fixed income and most of the fixed income sectors, core bonds, corporate bonds, and even private debt. And I'll turn it over to Surya right now to see. Surya, I don't know if there's any other statements you'd like to make about maybe the nitty gritty of changes to the CMAs.
Sure. Good morning, everyone. In terms of what's changed from 2019 onwards is Fed policy and the interest rate scenario that we've seen. We saw COVID come through. We saw unprecedented monetary policy. We saw a cut in interest rates. And since then, we have seen Fed talk about tapering. And at this point where we stand today, Fed continues to taper, and they're expected to raise 4 times in 2022. And so I just wanted to touch upon the highlights. I mean, Alex touched upon the differences going back to 2019, and most of those differences come through in the fixed income space, because back in 2019, we were at a place where the Fed was going to raise rates, economy was going to move towards a trend growth. And since then, we saw the COVID disruption, and we saw very strong GDP growth last year. And this year, we're still expecting above trend growth. But over long term, though, we expect growth, the GDP growth to come down to around 2%. Our view at this point is that number will end up around 1.8% based on our views around labor force growth and productivity. And all of that's important because that impacts how we view long term. The long-term GDP growth projections impact how we come up with the long-term projections for equities. They also impact our views on interest rates. And where we stand today, we expect Fed to start raising rates in 2022. And as a result, you see that the returns expectations for fixed income are in the 0 to negative range. Let's focus on the core bonds there, which is the 7th line. Core bonds in the intermediate term are expected to return a negative 0.9%, and that's a result of the expectation of rates rising in the near term. Over long term, though, we expect rates to be more range bound. We expect the terminal Fed funds rate to be 2.5%, and that's a result of the debt that's accrued on the balance sheet. And as a result, we expect that the Fed might not be able to raise rates past that 2.5% over long term. So our long-term expectation of Fed funds rate is 2.5%. And what's impacting the shorter term or the intermediate term return expectations are the path to that 2.5%. So as I said earlier, you see that reflected in the core bonds returning negative 0.9% over intermediate term, but over long term, that number is close to 4%. Similarly, in the credit markets, in the investment grade corporate markets, we expect credit spreads to be more range bound, and credit spreads are one component. The yield to maturity or the interest rate expectations are another component of that investment grade corporates. And our expectation for investment grade corporates has come down, and now it stands at 0.1% for the next 5 years. I just want to emphasize that from a standpoint that when we say 0.1%, it's the average expectation over the next 5 years. Over longer term, though, that number is close to, again, 4%. Our view on the high yields a little differentiated. High yields more driven by economic growth, and we believe that the spreads within the high yield space will also be range bound, like in the case of investment grade. But overall, the return expectations for high yield are higher than the return expectations that we have for investment grade, and that's in line with the underlying risk associated with the high yield bonds.
And also, I would interrupt. Correlation with equities as well, which is part of. On the next slide, we'll see. We don't need to go there now, but part of our assumptions are correlations as well.
Yes.
Sir, if I just maybe want to kind of summarize, maybe a difference, a categorical difference between now and where we were 3-4 years ago, is this our view of the ceiling of where the Fed can take rates. And even though, let's say, our views on spreads are relatively consistent, it's that rate ceiling that permeates throughout the fixed income market, correct?
Exactly. We were expecting that terminal Fed funds rate to be around 3%. Now our view has come down to 2.5%. So that does impact the return expectations.
And maybe what are our views on, because these are long-term projections, and a question I got from Chris is, and Chris, to answer your question, these changes in these fixed income assumptions are enough to change the overall output from what we saw several years ago to now. Fixed income at 35% of the portfolio, and over a 30-year modeling period, by dropping it by percentage point or more in some instances, it will have that effect over a 30-year period in a Monte Carlo simulation. And so maybe, sorry, the question I'm getting back to is, do we view that ceiling changing again over the next 4 years, 5 years, 10 years, or is this more of reacting to a shift? We've seen Fed policy certainly change pretty markedly, maybe since the Greenspan years, and certainly since the 1980s and prior. Are we, is this now a new era of Fed management where we, like you said, we are in extreme range-bound interest rates that are not going to exceed these levels like we had seen, in the bond market of prior?
Yeah, that is our view at this point. We think that the long-term rates will be subdued because the long-term economic growth is going to be subdued. And if you think of the components of long-term economic growth, it's a factor of labor force growth and productivity. Productivity has been subdued since 2000s. We have seen productivity below that 2% level. So as a result of COVID, productivity has increased a little bit, but we haven't seen large gains in productivity. So until we see large gains in productivity, we cannot necessarily say that we would expect that, or we would change that long-term GDP growth number from around 2% to higher than that. And we all know that demographics are in a negatively trending environment. So we do not expect labor force growth to have a greater impact. So it's the productivity growth that is going to drive that long-term GDP growth.
And that's a good point. When Suri mentions that, how we, again, our equity long-term views are based primarily around GDP. How do we get to our GDP views? It's a factor of productivity and workforce population. The amount that a single person can produce multiplied by the number of people out there producing. And Surya referenced demographics and productivity. I think to answer some of the questions that Chris and I spoke about offline, something that may significantly change these in the future is a jump in productivity. I don't think we're predicting any decreases, a technological paradigm shift, of which we don't know now. That would be an event that would have a market change on these, Chris, that would lead to something interesting. So I don't know if there's any other questions on this.
Alex, can we pivot a little bit from what Chris may have talked to you privately about to what I have a couple questions now.
Sure.
And I want to look at long-term projections because while I appreciate the macroeconomic review, I want to talk a little bit about the 2019 information, the capital market assumptions that were provided versus the current capital market assumptions that you're providing. I'd like to look at three areas. I'd like to look at U.S. equity, core bonds, and private debt, since private debt is really the issue we're talking about. So in 2019, the long-term projection you gave us was 7.5%. Currently, it's 7.6%. Not much of a difference in the U.S. equities. In the core bonds, it was 5.1% in 2019. Now, understandably, it's lowered to 3.9%. So 1.2% spread, right, between those. And then the private debt, which is the issue in question, you gave us an 8.3% projection in 2019 and a 6.8% projection now. And this is long term. So that's a wider spread than the core bond spread. So my question is, why is private debt still a good idea in the long term if the spread, if the return that is being projected now over 30 years is considerably less of a spread than the spread between the core bonds?
Sure, I can take that. When we're thinking about private debt, we are thinking of it through the lens of leverage. And what has happened is that because we're expecting lower interest rates, the cost of leverage has come down. And as a result, you're seeing that private debt, because of use of leverage, is coming up at a lower spread than what you're seeing for core bonds. So it's the impact of leverage that you're seeing there.
So from our perspective, as individuals making decisions as to where the fund's money should go, what is the advantage of investing in a 6.8% projected return that is now lower than the 8.3 projected return at the time that we made this decision to go with this 7.5% in alternative investments? Why does that still hold up is really my question.
Good morning, everybody. Let me just try to add to what Alex and Surya just mentioned. My name is also Alex and also Gurvich, so here they confuse between Alex and I, two AGs, but we are definitely different in sense that, so in terms of specifically private debt, we look at private debt as an extension. It's not a different asset class. It's an extension of fixed income. And so what you're looking at is the question is, if you still need an allocation to fixed income as you have in your portfolio currently, the question is which segments of fixed income you should be in. And so what it means is that if you want to still have, here we have a negative yield, negative returns in the short term, but over long term and even intermediate term, if you still want a fixed income to provide a ballast and a diversification and risk reduction for the portfolio, where in fixed income you should be, and that's where that's where bank loans, private debt comes in. Because
okay, so I just there was an article in the Wall Street Journal today, which actually Chris forwarded to me, which is actually entitled "Lending by Money Managers is Booming. Funds that make private loans control about $1.2 trillion, nearly twice the capital they had 5 years ago." And it talks about various loans that are being made. But one of the things that Moody's Investor Service commented on in the article, and I'm just going to read it. Private lending is opaque, lightly regulated, susceptible to conflicts of interest, and concentrated among a small number of large fund managers. That poses risk to the financial system. The economy is increasingly exposed to the governance and risk management of these asset managers. The reason I read that is because if you're telling us that this is a substitute for fixed income, it's not regulated like the fixed income industry is. It's not the same. So, in fact, one of the biggest returns last year was a money manager who purchased a group of bonds from a group called Affirm Lending, which gave consumer loans at high interest rates, higher than normal interest rates, between the amounts of $500 to $700 to consumers. And they did $500 million of those loans. So, Alex, when you mentioned moral hazard earlier, for a public pension fund to be invested in something like this that is charging, higher interest rates than normal to consumers, that could be a moral hazard for us. That could be a problem for us. So I only point this out because, Don mentioned some things a couple of meetings ago about how these companies make money, where's the spread, and Don's been in the banking industry in his whole career. So, I have a little bit of concern about not the investment itself, because it's a brilliant business idea, but about the idea of construing this as a substitute for fixed income, given what Moody's indicated was an opaque, lightly regulated, and susceptible to conflicts of interest industry. That's my concern at this point.
In reaction to that, Fran, I think that's why, when we go into any asset class like this, there's only active management available in private debt. There's no index. This doesn't represent an index here. It represents, the average of a universe of investors or of investment firms. Our role and your role is to pick the funds that are available that, after, lengthy due diligence, connection with references, review of prior funds, a look at active investments, that we would expect or hope to be top quartile funds, exceeding, our projection, as well as exceeding the actual universe return in private debt, but also that are not engaged in practices that we don't agree with. And I don't think we would ever bring a consumer lending strategy to any fund like this. And if you look at the funds that we interviewed, for our private debt search, there was nothing close to consumer lending at all. I think, almost all of that was sponsor-backed, senior secured first lien debt. Some of it may have been unitranche in the existence of, a singular layer of a capital stack. But, for Alex to make that statement that it's, we view it as not the same as fixed income, but it's an extension of fixed income. It's another subsector of, a yield focused investment.
I appreciate that, and I appreciate you telling me what my role is. I think I understand that, however, but the point being that there are for Moody's to make that statement is concerning to me. That's all I'm saying. I'm not saying any of the specific investments that you presented are involved in that particular field. I'm just telling you what Moody's said, and that was an example of something being what could happen when something is lightly regulated and opaque. That can happen, and there's nothing to say that an investment that we enter into today that may not be involved in certain areas decides to get involved in that area at some point because they see other investment managers reaping. Actually, their returns were over 20% for that one company in that consumer loan area. So if a company sees that, they may decide, hey, you know what? Maybe I do want to get involved in that area. And if there's nothing prohibiting the investment manager from doing that, it's lightly regulated. So again, that's partly an aside based on, you reminded me earlier when you mentioned the words moral hazard concerning something else that is totally unrelated to investments. But for a public, we're not an endowment, right? We're not an endowment. We're not a family fund. We are a public pension fund, and those moral hazards are important to us. So that's why I wanted to point that out, not for any other reason.
And the same thing, frankly, has begun to exist in the equity markets. With the vast prevalence of indexing, certain asset managers now own immense issuances of equity float, controlling proxy votes, etc. as the S&P 500 has become increasingly concentrated at the top, does that invite its own type of moral hazard? For entities like Vanguard, that are, where they own something like 17+% of the U.S. REIT float in the United States. There are some, there are some significant concentration issues out there as well.
There
And
are,
so,
and I've read those articles also. But however, again, concentrating on a public pension fund, when you talk about proxy issues and moral hazard, we have a responsibility as a public pension fund to look at issues and exercise our proxies and have exercised our proxies as public pension funds in a way that we believe has benefited society and benefited individuals. So I get what you're saying about Vanguard, but again, I'm focusing on us as a public pension fund. We can do what we have the ability to do, and we have done that. So I understand what you're saying. I want to focus on us as a public pension fund.
So anyway, I guess, the broader point is, why alternatives? Why private debt? It's not just private debt. It's private debt as part of, an alternatives program in general. And, when Alex, Suri, and myself were talking, last week, the other day, we all agree, this, that's approaching 700 million. There's a lot of ways we could take this, but when we just look at it in a vacuum, there is some room for diversification in this plan. Alternatives are one way to achieve that diversification. You can achieve it through more regulated, listed liquid options as well, if that's a direction that the firm would like to take it. Alex or Suri, I don't know if you want to speak to any more highly regulated subsets of the fixed income market. I suppose high yield, listed bank loans are options, but again, how do those compare to the core universe?
One very friend, if I may say, I think we understand the moral hazard, so thank you for pointing it out. Just one quick example. There's a lot of focus on public markets, on bank loans and high yield, right? And that's because it's a high yielding environment. It's very attractive in this low interest rate environment. If you look at the statistics, these are regulated, right? These are regulated as you pointed out correctly, and where private debt is less so, as you pointed out. However, the default rates are 1/10 within private debt relative to the high yield and bank loans. It's actually a bit less. So the fact that it's less regulated is correct, but the results on the ground actually give you a different risk view. So in other words, in fact, in private debt and in bank loans and high yield, you may have higher risk than in private debt, simply because of the defaults. And private debt, just one more specific, is that, as Alex mentioned, usually private debt firms who invest in these companies, these are very solid firms, solid cash flows, and they have good control of those firms. Whereas opposed to in high yield and bank loans, you only a small investor, and if the company defaults, you have no way of managing that process. So there's actually hidden risks in this public fixed income markets that are less talked about, and obviously focuses on private debt. So I just want to give you that one example.
Thanks, Alex.
So we can move on and see the the impacts of some of the changes on the output. I don't know if we need to focus on this. These are just the correlations that go into the Monte Carlo simulation. You can skip ahead. So this is a view of the output. The current the current 65-35. This is really reflective of the investment policy, prior to the changes. Still the base asset allocation for where we are today. with about 2% move to cash, which has historically been, the cash in this plan has been between 1% and 2%, or 1% and 3% or so. So we wanted to, seeing as that'll typically be the case, leave that there for consistency. It doesn't make much of a difference. It comes from core fixed income. Also here, this is with no alternatives, 5% higher equity moving to a 70-30, 5% lower, 60-40. I actually can't see the output because of this thing on my screen. Hang on a sec. Bill, can you scroll down slightly? Or keep it on that page, but or make it. I can't see the numbers because this this gray box is blocking it. I mean, you all. All right. Well, I'll just have to lean in really close to see it.
Alex, you should be able to grab that gray box and slide it over.
Oh, really? I can't. It's not working for me. I don't know what's going on, but I can just kind of read through it. I think we'll focus on the long-term assumptions mostly here. There's nothing, unexpected to see. Increasing the equity from, by 5 percentage points takes the expected return up 0.2 of a percentage point. Decreasing it takes it down 0.2 of a percentage point. Where the impact is felt is in the higher variance of these portfolios. A standard deviation of 11.5% versus 10.9%. When you increase the equity of the portfolio. So, again, these portfolios are lower than what they were in 2019 as a whole. Again, primarily as a result of just a decreased outlook for fixed income over the next 30 years, as we talked about. So that's, again, why as a whole, the expected return looks lower than it did in the past. I will also say that, the way that these assumptions are compiled and these portfolio, this is with formulaic rebalancing, monthly rebalancing, no tactical asset management. So again, you're constantly being rebalanced back to that base allocation. It doesn't take into account, overweights, underweights, what have you. It doesn't take into account active management. And, as you'll see at the end of the, talk today, even over the past several years, active management has added value, and over long periods of time, it's added value in a number of asset classes. So all of those things are not taken into account, and we hope, that's why we exist, that they add value certainly over a 30-year period. So this is a purely illustrative, non-active portfolio in any way. And again, to sort of to get towards the goal return. If you're using the public markets, you've got to assume a little bit more risk and volatility. So I don't know if we want to move on to look at the output with some alternatives. It's several pages down. We may have to do some flipping back. I think it was 6.7 and 6.9 with 10.9 and 11.5. So what I recall.
I jotted down some numbers on this chart on page 12, just for ease of reference. And if you go to that PGW 7.5 alternatives column all the way down to the bottom under long-term assumption, 30 years.
Sure.
The probability of reaching 7%, the last column. So the number there is 47.9% chance of reaching 7%, right?
Sure.
So the PGW on page 6, don't go back to page 6, Billy. The 65-35, that's 44.5%. In 2019, the chances of reaching 7% were 54.2% with the 7.5% alternatives. So from 2019 to now, the probability of reaching 7% went from 54.2% to 47.9%. Again, Sori explained the changes in the markets and so on and so forth. I understand the macro reasons for that. But nonetheless, what we're looking at is 47.9 versus 44.5 for our current portfolio, right? That's really the comparison, isn't it, for that 7.5%?
Yeah, sure.
So that's the difference. I mean, that's the difference in this fund reaching its long-term 7% with the proposal that's being made for the use of the alternatives, right?
Yes. And
And I'm trying to help. What I'm trying to get is some sort of feedback for given for example on page 13 the efficient frontier charts that you provide and shows the risk, the standard deviation in the risk and where private debt is compared to core fixed income on a risk return ratio. The question is that couple of percentage points, 44.5 to 47.9, and I don't mean to diminish those percentages, by the way. I mean, that's a real difference. I'm not diminishing that. But in a risk reward scenario, my question is it worth the additional risk of, I want to call it private assets, because this is a long-term assumption. So I just don't want to focus on private debt, because the private assets include things other than private debt. And we're talking about an asset allocation here. So the fact that the private assets and the risk with those private assets and the fees with those private assets, is that percentage difference of reaching 7% worth using those as in our fund, given the funding percentage of this plan also, by the way. That's another factor. So I don't want to look at it just as a general sort of macro issue. I want to look at it specific to this plan and specific to the funding percentage of this plan. That's really my question.
So there's all different ways to look at it, and we should be having a good discussion about this. And there's a number of different risks. I think I'll first address the illiquidity risk. And again, I get back to, as you said, it's 3 percentage points of probability. I think it's about 0.2% of return, which again, I think the target return was decreased by 0.3% of a percentage point a year or two ago. So, and I don't know, again, when that decision will be able to be made again. So we're looking at, two-thirds of a decrease in discount rate, roughly, is what you're getting from these alternatives. That's another way to look at it. And knowing, if and when, the city will be able to lower this again, because we always, everyone I think always is on the page of lowering assumptions when that's financially doable. The plan, was over 80% funded, if I'm correct, as of the latest actuarial statement. As plans grow both in their size and funded status, they can assume more illiquidity risk. And so, that, is less of a concern for us at this state in the plan. Not only have we had no issues making the monthly contributions, we've been, drawing from them at a pretty tactical rate. I don't think, adding in illiquid alternatives would change our ability to make those, tactical withdrawals to fund or lack of withdrawals to let cash deplete, as we've been doing over the past 4 years. Also, it would, invite the ability to tactically, fund those commitments over time based on changing, underlying market conditions. And the illiquidity also provides some diversification. Right now the plan is all public markets. And certainly there are correlations between private equity and public equity. But in periods of high volatility, whipsawing markets like we've seen from, December 2018 till now, the difference in correlation between public and private has been enough to smooth returns. And for some, public funds, that's what is a key element. So there's a lot of ways to look at it. I think, long story short, I think the fund can certainly take on some illiquidity risk. It's up to you all on how you want to view that versus maintaining this public market volatility.
And if I may,
go ahead, sorry.
Yeah, I just want to point to slide 4, and that's another way of looking at those numbers. Fran, you make a great point in terms of the percentage, the probability associated with it. And, you're asking the question, is it worth that extra risk? Because you're only going from 44 to 47. So to think of it from an academic standpoint, if you go to slide 4, which has those correlations, what it's showing is how differentiated the returns are across these different asset classes. For example, because we're talking about private debt here, if we were to follow that private debt line through, you do see that private debt tends to have a 0.6 correlation to US equities. There are time periods when you could see that approach 1. There are times of intense market stress like March of 2020 where you see liquidity dry up in the overall market, which could impact private debt as well. So those are black swan events that we were talking about earlier in this conversation. But that in itself offers diversification over long term, being able to assemble different pieces that are not moving on a one-on-one basis, but are able to kind of offer that diversification from a return stream standpoint over long term. That does not come through over short time periods. You won't see that maybe happening in a period of 6 to 12 months, but over long term, you do see that come through. The other thing to note here is that while core bonds, if you go down that list, core bonds have a 0.3 correlation to US equities. What we've been saying is that because core bonds have lower return expectations, where else can the portfolio be invested? Again, like Alex pointed out, there is a liquidity risk that is to be taken. And there is also the issue of how comfortable are you with the allocations that are presented and what kind of allocations you want in the portfolio. So that's of utmost consideration here. But just wanted to point out from an academic standpoint, that's what would tilt that balance.
I have a question.
No, that's right, Sori. That's exactly what I was asking, and I appreciate that response. And then just one last thing on the numbers, again comparing the previous recommendation. And the reason I keep going back to the previous recommendation is because that's the recommendation that this group used to make the decision to go into alternatives. That's the only reason I'm doing it. And I'll have a question after this. So this, in the 7.5 alternative scenario, the difference in probability of reaching 7% then and now, they're the numbers I'm going to give. Under 7.5, it's a 6.8% less probability. Under 5%, it's a 6.6% less probability. And under the current PGW plan, it's 7.3% less probability. So they're the reductions in the probability of reaching 7% from then and now under the 3 scenarios that were given previously. I didn't say 2.5 because that was not a scenario that was given previously. So I can't comment on that. But so the question remains, given those reduced probabilities of reaching 7% over the long term. By the way, that's the not the intermediate term. That's the long term. I think the intermediate term spreads might be a little larger actually. But given those differences, does it still make sense 2 years later to still enter into alternatives given those reduced probabilities region? That's really the bottom line question. I mean, we could talk about all the different things,
Yep.
but that's really the bottom line question, and that's what I would like you folks as experts to provide guidance to us on.
I actually look at your number in a twofold way. One is the numbers behind it. What's driving those numbers, right? And that's being driven by Monte Carlo simulation. So if I were to simplify it, I have, say, 3 kids, and one gets 10, one gets 20, and one gets 30, the average being 20, but one gets 5, one gets 45, and the other gets 30, that the average, the probability of getting to that average varies because there's one weak link in all of this. So I think that's what's impacting the probability here, that, you know, when it's running that Monte Carlo simulation, you have core bonds that have lower return now. So when it's taking that, and then when it's applying that standard deviation around it, basically what it's doing is that it's taking the mean, and then it's applying the standard deviation, and it's coming up with 1,000 possibilities. And it's saying that if I were to average all these 1,000 possibilities, what's my expected return? So because you have lower return expectations for core bond, for fixed income as a whole, that's kind of impacting that probability number, because it's averaging around it across 1,000 possible scenarios. And in each of these 1,000 possible scenarios, the return expectations are lower than it was in the past. So having said that, I think you're asking a great question, which is that in 2 years, does it make sense to still add to alternatives if the probability of expected return has come down? I think what we're saying is that it does offer a diversified source of return. So it does make sense to consider it as a diversified source of return, given where the assets are at for this plan. But at the end of it, it all does come down to your preference, and it comes down to how comfortable you are with making that allocation.
Well, yeah. So you are renewing that recommendation. I want to be clear. That's I mean, that's the question.
Yeah.
Yeah, I mean, I think,
Yes.
you know, yes. And, you know, to look at it like this, you know, 2 years ago, if you had begun funding immediately after making that decision, you know, from fixed income to private debt, the plan would have benefited between now and then, or between then and now. If we come back in 2022 and we show this same document we've shown today, you always have the option to slow commitments and stop commitments. You know, and you bring them to a complete halt. You can scale commitments up. You know, this is always, asset allocation is always evolving, even strategic asset allocation. You know, we recommend looking at it every year, every other year. And so, you know, again, I think the sum of all the discussion today is, you know, PFM believes that there is room in this portfolio at approaching 700 million, at over 80% funded, with the commitment from the city to, you know, overfund commitments as it has been over the last several years and continue in the future. You know, to add some alternatives with the potential to diversify and enhance return, you know, based on where they're sourced from and at what time. You know, do we need a 7.5? Does it need to be a 7.5% target in the IPS? You know, I don't know. We can, you know, there are other interesting structures we can amend this to. We could look at a 0% alternatives target with an allowable range between 0 and 10% to allow for tactical deployment of alternatives during periods when we find that certain strategies may be very useful. You know, that's you know, that's one way to look at it.
Alex, does
Yes.
it, one of the numbers, and I discussed this with you, I've talked about it with a couple of the commissioners or their designees, that surprised me, and and Fran's hit on it a couple times, but the overall probabilities, with alts going from mid to high 50s of beating the 7% down into the 40s, and that the magnitude of that surprised me, even with new capital market assumptions over 30 years. Does it cause any concern for PFM that, to your point, had we started down this road 2 or 2.5 years ago, now we would have made investments, and depending on how quickly we had made those investments, we would be locked in over a 10 or 12 or 15-year period, and we wouldn't be able to as easily change the overall structure allocation of the plan the way we could with public market, vehicles. So to that point, had we ramped up private debt, we had gotten to 3, 4, 5% with that in real estate or that in private equity, whatever the mix is. Now we're locked into 10 or 12 or 15-year vehicles. Then we get new capital market assumptions that drastically lower the return probabilities. But now we can't get out of those investments or change the structure the same way we could with fixed income and equities. How much of that, if at all, causes concern to PFM?
So maybe I will address this since we talked about specifics to this plan earlier. The plan for funding alternatives was never to get up to the full 7.5% over a 2-year period, Chris. So, we would not have been locked in for the full commitment, certainly. And also the commitment schedule we set forth was to prioritize earlier distribution, lower duration term funds earlier. Private debt, which distributes more of its capital back earlier, and in general has lower fund terms. So again, specifics for this fund, I don't think we would have been in that type of situation where the full commitment is locked up for, again, 15 years is also a little long. 10 is the average for private equity and private real estate. Private debt is about 5 to 7. But again, more philosophically, the changes really occurred. And again, as Surya mentioned it, the changes really occurred across the board, coming largely from core fixed income. And when you look at, we're on this page right now, the percentages in all of these portfolios, as well as what they had back in 2019, 27 to 25.5% in core fixed, taking a percentage point drop in its assumption that's then modeled out on a 30-year annualized basis. That's where that magnitude is coming from. I would frankly, it almost presents an example, a case of it would have been better to get into private debt 2 years ago, perhaps. More broadly, that's always the illiquidity risk that you take. And that's why, again, I mentioned the fact that the funded status, the size of this fund, the contributions that have been coming in from the city, I think warrant, again, a small allocation to alternatives. We're not talking about restructuring the whole portfolio here. It still, leaves you with about, 95 to 93% of the portfolio, at least under the current allocation. Again, and we're certainly open to amending things, changing how it's implemented, but that you have, daily liquidity with and can restructure, at a whim. Meanwhile, you're beginning to get distributions back from those funds as well. So, I hope that helps, but I think that
Alex, Chris, and Alex, if I may add to that, and Chris, to expand on that question and answer, is that just looking back historically, and history obviously does not, that's history. Over past 2 years, you certainly would have benefited in privates, period. You probably have seen private equity, venture capital specifically had spectacular results last year. That's a one-off. It's not typical. It should not be expected going forward. But if you would have started investing 2 years ago, you'd probably be maybe about 40 to 60% funded. And then, as Alex mentioned, specifically on private debt, you'd also be getting cash flows back because it's an earlier return stream than private equity. And then the other thing, what I wanted to mention is, as you correctly said, there is illiquidity. There's a risk of being locked in for 10 years. But people look at it as a risk. There's also a flip side to that. There's a benefit. As you might expect, as you might see, and we all know that black swan events, type events, like Surya mentioned, whether it's GFC, 2001 crash, or COVID, what happened just recently, if you look historically, it happens once every 7 to 10 years. So it's kind of like a typical business cycle time frame. So you can look at these investments that 1 or 2 years out of the 10, it would make, and they'll be across the board, not just privates. You would reduce the returns for 1 or 2 years, but over the 10-year period, privates would add additional returns relative to public. So that's another way of looking at it. Again, I'm just trying to provide you the full picture, and of course you're in the decision seat, but I just want to make sure you see the full the full picture.
So yeah, again, I think at the end of the day, summarizing everything we've been saying, I don't think our views were changed in that a little, alternatives, including perhaps some illiquid alternatives, under a structured program overseen by a consultant, implemented, with the best-in-class managers we can find, implemented in a strategic, and tactical manner over time, as we've proposed, it would benefit this portfolio.
I don't want to belabor the point, Alex, too much, although you probably think I already have. But I just want to. You said tactical and strategic. I want to go back to Chris's point. What Chris said. If we would have entered into this 2 years ago and maybe started to deploy money within the last year or so, whatever the time frame would have been, certainly would have been positive for the year or whatever the period of time is the money would be in. But going back to what Chris said, the difference in projection in a couple of years is substantial. It's not. So what would be the tactical move or strategic move to make when the market assumptions have changed so much? I mean, what do you? There is no tactical move to make at that point. You're just
well certainly there always would be. I mean, I think, let's say we had begun our commitments right on schedule 2 years ago. Maybe by now we would be at 1.8. Maybe in called capital, with at most, I'm looking at 2 commitments having been made. So there's still a lot of room to shift, to again, halt new commitments and pursue, let's say, at this point, an overweight to equity strategy. The data is showing us that fixed income returns are down across the board. We view shifting from core fixed to, private debt and other illiquid alts, including some real estate with a blend of equities and fixed, sourcing that, and shifting equities to private equity is not going to be enough to get us there. Now we can pause this program. We're still within the allowable bounds of what the IPS says, which is 0 to 10. We're below the target at 7.5, but that's okay. Because tactically, what we're now seeing is, we want to be up over 50%, and to do that, we're going to we want to add equities, and that can be the program that we make at that time.
Yeah. So yeah, it's deciding not to pursue the alternatives for that given period of time. That's the tactic. As opposed
sure.
to
I mean, and if there's other tactical options open to us. Secondary sales are always on the table. I don't always advocate for pursuing them, but we've overseen some, and that's always an option as well. again, I think when, we'd be looking at, the commitment size where, a secondary sale for operational purposes, liquidity purposes wouldn't be necessary. It would be a decision shift that would say we want to get out. And even in the last 2 years, Fran, this shift would not cause us to want to get out.
No, yeah. Well, you can't get out. Well, you could get out with agreement of the limited partners, but otherwise,
Well,
you really
a secondary sale.
Yeah, we're
is what I was
familiar with that. We've done that in the large fund. I understand the secondary sales. All right, thanks. But that's all maneuvering to make just for a couple percentage point difference is kind of what I'm saying. That's anyway. Go ahead. I'll let Nick.
Yeah, just to follow up on that, on Fran and Chris's point. I was also kind of surprised by the magnitude of the drop in the probability there. I think over the 2 years, it's something like a 12% drop in the probability. So I was, the question that came to my mind was, as we're thinking about making a, pretty significant change to the plan and a plan that, since inception has almost returned 9%. All models are imperfect, but it seems with such a large change in a short time that I would imagine the uncertainty in these assumptions and these models are relatively large now, compared to usual. And with such large uncertainty, does it make sense to be shifting the allocation and moving away from something that has performed well in the past? So I guess if you could speak to that a little bit, and I don't know if you've done back testing on these models and have uncertainty ranges. I'm trying to get a handle on how to interpret these numbers, because if everything goes according to plan, this looks great, and the expected return, those are meaningful, meaningful changes in those probabilities. But as we know, things rarely go according to plan.
Yeah,
sure. Go ahead, Surya.
Talk about that. You're right. I mean, there is uncertainty embedded into the assumptions here, and that's why we tend to err on the side of caution. What we come up with are very conservative estimates. When we say 7.5 for equities, the expectation is that it would be higher than 7.5. But if we were to come up with a very conservative estimate, what would that be? For the last 3 years, the average for S&P 500 was 26%. I mean, if I were to show this in 2019 and say that the intermediate term returns are, I would say 7% maybe. So over the next 5 years, the average is 7%. And you take that and then apply the last 3 years where you have an average return of 26%, that's so much out of bounds than what we had projected. But I think for us, these are more of a guiding rails than anything else. It's what's the directionality here? What are the different fundamental factors that we have to take into consideration when thinking of investments, and what are they pointing towards? The biggest things that looking ahead in terms of, I wouldn't say certainty, but something that is going to transpire is the level of interest rates, and that's going to have an impact. The level of GDP growth driven by lower demographics and lower productivity at this time. So if something were to change, maybe we see some sort of a technological revolution where the productivity really jumps up. Maybe that leads to a higher GDP growth. But you're right, Nick, in saying that there is uncertainty embedded in these numbers, just because there's no way of saying what's going to happen in the next 30 years. But it's an exercise of, based on the information that we have and based on our understanding of fundamentals, what is a good conservative estimate that we could come up with? And they would change from year to year. And that goes back to what Chris and Fran and you were saying too, that, the probability has come down and those numbers could change. Maybe by next year, if in 2022, let's say we see 4 rate rises, in 2023, maybe the expectation is that we might have 1 or 2 rate rises, and then it kind of plateaus from there because inflation has been subdued. And as Fed raises rates, the transmission mechanism occurs such that in 9 months, you kind of see a slowdown in credit conditions. So as Fed starts tightening from a rate standpoint, maybe come 2023, we're looking at trend growth. And if we kind of take that into consideration at end of 2022 with no rate rises, maybe the core bond expectations look slightly better than what we had in 2022 because the negative returns have already been had from a rate rise scenario standpoint. So there are different factors that kind of come into play on an year-on-year basis. I think it's just the general directionality of where things end up that we should pay more attention to. I know that does not perfectly answer the question of probability being lower, but that again, I think that gives a good framework around that uncertainty that you've been referring.
Yeah, and it's one tool of many that we use to to help make these decisions. If we were to extrapolate this out, it would we don't purely make decisions on the output of a model. We never have. I don't think we ever will. Maybe we could have extrapolated this out to show higher portfolios that we would not necessarily be recommending due to the extreme volatility, but to show where they show up on their expected return. We always advocate for tactive management, effective utilization of good active managers, and that combined with choosing the right strategic allocation and doing as we're doing today, knowing when to make that shift or not, or maintain, to continue on with the current tactical program, as part of it as well. Thanks, sir. I wouldn't have said anything different than that.
Thanks. That was helpful.
So I don't know, again, if there are any questions or we want to. There's a number, like I said a while back, there are a number of ways to implement this.
Can you quantify the downside of not doing anything, but just moving forward with the same allocations that we have?
Yeah, I can. Again, caveating everything we just said about that this is a model, et cetera, increasing alternatives, the current target versus no alternatives results in about 0.2 percentage points of enhanced return over 30 years with no enhanced volatility or minimal. I think it's slightly reduced volatility. So you lose about a tenth of a percentage point in volatility. You gain 2 percentage points in return. It's not as much magnitude as we showed in 2019. But again, this model is showing that alternatives generate risk-adjusted return for the portfolio.
Thank you.
I just want to go back one thing to what Nick said. Nick's point about the difficulty sometimes of projections. And kind of an extension of Don's questions. In the 2019 capital market assumptions, your intermediate term, which is the next 5 years, U.S. equity expected return was 6%. I think that's like 1 quarter's worth of return in the last since that projection was made. So it goes to the point that the projections are not always, well, that's why they're called projections, right? They are our best estimates, our best educated estimates on that. So, it's Nick makes a good point when he brings that up. That's all.
Yes, absolutely. If you go back to 2019, valuations were elevated, right? And when you're thinking of shorter term, we were expecting earnings growth of say 6-7%. and the multiples were already expanded. If interest rates were going to raise, if Fed was going to raise interest rates from there on, maybe we won't see equities being as attractive as they were up until that point. So the view was that all the returns that we would accrue in the US equities would just come through from the earnings growth that we will see. So yeah, nobody saw COVID, nobody saw the extended valuations, nobody saw the fiscal and monetary stimulus that came through. And yeah, you're absolutely right.
Well, where are we?
No, I think that's the end of our presentation on this topic. I don't know if there are any action items. Again, nothing has been funded. There's a target for 7.5% in the investment policy statement. We continue to look at all sorts of funds. But we want to have some clear direction before we continue, bring more to the table here about what the process you all would like to take.
My suggestion is that we continue on with the items on the agenda, and then the commissioners at the conclusion have a discussion amongst ourselves, if that's possible.
Yeah, that's totally fine. It's on the agenda, so there's no issue with that, Don.
Thank you.
Like I said, I don't think there's much of an update on Golub. We continue to, that decision, as well as, a number of other funds that we've been looking at related to the city of Philadelphia, hinge on whether to proceed with the alternatives funding. I don't know if you want to go down to we can have a brief active passive discussion. As we've been engaged in an ongoing RFP for a potential replacement for Pinebridge. Pinebridge was added in 2019, I believe. Let's go up. It's not. It's in the It's in the PowerPoint. I'm sorry. So you can go down a few slides. Okay. So I'll go up one more. So the question, again, we're looking at, Pinebridge has underperformed since its inception by about 1 percentage point. We issued an RFP middle of 2021 for active funds. Also on the table is potential, just shifting to a pure passive strategy in large cap, or sticking with Pinebridge. They had a decent year in 2021 and have recouped a good amount of what they had given back at the onset of the relationship. You may recall that Pinebridge has significantly reduced their fees. It's now an incentive-based fee schedule, which goes back to the beginning of the relationship. So before they get any incentive fees, they still have to claw back to their, that remaining bit of underperformance. And in the meantime, they're charging, I think, 2.5 basis points. So you're getting roughly, index level fees for a quantitative strategy that, again, more recently has performed as expected. I think 2020 in particular was a bad year for quant strategies as a whole. Pinebridge itself suffered. But in going through this, the question we've had both with Chris and on these calls as well, is it worth maintaining this allocation to active management within the very efficient large cap space? So we have some data here. I'll turn it over to Surya. Again, I think it's a bit of a philosophical discussion. but we'll present our thoughts and views.
Sure. In terms of our views, generally, we prefer passive managers within domestic equity. What we've seen in the large cap active space is that active managers have struggled. Only 50% of the active managers have been able to, or less than 50% of the active managers have been able to outperform the benchmarks. I have those data points in the rest of the presentation here. And when you look at it from a lens of risk-adjusted returns, what that means is basically return generated for every unit of standard deviation. Why that's an important consideration is because you have managers that tell you that we provide good downside protection. We run a portfolio with lower standard deviation than benchmark. But if that return over that standard deviation is not outperforming the benchmark, which is basically the return generated for that unit of risk, then they're not doing their job because they're taking less risk. But for that less risk, they should be generating an equivalent amount of return, if not better than the benchmark. So, and this is a well-known secret, right? That large cap active or large cap domestic equity space is an efficient asset class, and it is hard for managers to outperform in this space. But having said that, there are managers out there that are outperforming. It is not impossible. It is difficult, but it is not impossible for these managers to outperform. For example, we have allocation to a large cap manager in our OCIO portfolios that underperformed for the first 3 quarters of last year, but then they made up all the underperformance and outperformed in Q4 of last year. So that's something that you see with active managers, that when there is that increased volatility, some of their ideas come through better than in periods where you see a low quality rally or you see a rally in the top names. That's something that has impacted the markets more in 2019 and 2020, where we saw the FANG stocks do really well, and managers that were not allocated to these FANG stocks were underperformers. But on a whole, our viewpoint is that it is difficult to beat the benchmark in the large cap space. Having said that, so the portfolio should be predominantly passive. Having said that, there is room for active management, a sliver of active management, because active management does add value from time to time. We've seen that come through during periods of increased market volatility. If you were picking managers that are focused on, say, better balance sheets or higher quality financials, or companies with higher ROE. These are the different ways in which managers tend to outperform the benchmark when there is market stress.
Surya, do you want to maybe take a second just to talk about Pinebridge and how their performance has changed?
Sure. Yeah. So Pinebridge is a low tracking error quant strategy. What they do is that they look at the universe of S&P 500 stocks. They break it up into 6 sub-universes. And within those universes, they have different models to create a portfolio that's better than the benchmark. And when a quant strategy does that, they are basing it on a multi-factor model. They're looking at things like value, growth, momentum, quality, and they're saying that what combination of value, growth, momentum, and quality gets me a better than benchmark portfolio. What's happened in 2019 and beginning of 2020 is that the factors had a huge impact on index performance. What that means is that typically when a quant manager is building that model, they're relying on historical data, and they're saying that if value is trading at a 90th, or value is 90th percentile, or value growth spread is at 90th percentile, we expect that spread to compress. But that did not necessarily happen. What we saw was that growth as a factor continued to outperform, and managers that were building these portfolios based on a combination of value, growth, momentum, and quality, they were underperforming the overall benchmark. And this is not something unique to Pinebridge, but this was seen across quant managers because quant managers could not capture the quick changes or quick shifts in the market that happened in 2019 and 2020. But since then, since the second half of 2020, the performance stabilized for Pinebridge and their performance came through well in 2021. They have outperformed the benchmark by over 100 basis points in 2021. And again, that's something that we're seeing with other quant managers as well. One thing to note is that the expected performance range for Pinebridge when we onboarded them was that we would have expected them to be within that 100, 150 basis points of tracking error to the benchmark. They deviated from that with their underperformance in 2019 and 2020, which is why we issued the RFP. But in 2021, their performance is in line with expectations.
And picking up on that again, we issued the RFP to see what other options were available, to see who responded. And also, I think as we presented at a meeting, I don't recall when, we also noticed, I think Surya attended and gave a presentation stating that the market conditions for a fund like Pinebridge had begun to improve. We did a follow-up showing that indeed their performance has improved. And then when we'll look at it again in a few minutes, you'll see that it's continued to improve from then. So our recommendation at this time is not to abandon this endeavor, but given what I just said, that not only has Pinebridge met expectations over the past year, when we thought they should be on the upswing, but they continue to do so, and they're at a very advantageous fee for that active management. So I think the recommendation at this time from us is to continue to monitor, while continuing to, update this data, have discussions with Chris, continue to monitor the funds that responded to the RFP as well under, current market conditions. If it becomes, a pressing issue, or if Pinebridge again gets to the point where they've recouped everything and now are earning an incentive fee, maybe that's the point at which we revisit this decision again. But I don't know if there are any questions on our views in this segment.
Alex, can you explain the incentive fee briefly?
I don't know what it is off the top of my head. I apologize. I have it. I have it somewhere. It's in our notes to the annual fee.
I have it.
Oh, you have it here?
Yes. Yeah. So the incentive fee is 20% of any outperformance. And what they've told us is that they had underperforming, and this discussion happened in June of 2020. They had underperformed up until that point. So our understanding is that they will carry over that underperformance, and the incentive fee will start kicking in once that underperformance has been recouped.
Is the incentive fee in addition to a baseline fee?
Yes, of 2 basis points.
Okay.
I think it might be, is it 2 or 2? I think it might be 2.5, maybe. I can't recall.
Okay, I have the fee schedule as of June 2020. I don't know if there was further amendment after that, and I have it as 2 basis points here.
There may have been a slight amendment, I think.
Okay.
I'll confirm that.
Okay, so at any rate, it's similar to I'm not comparing it to a hedge fund, but the fee structure is 0.2 and 20% of any incentive fee. What's the hurdle for the incentive fee? Is there a hurdle for that?
I have to.
I don't think so. Again, I'd have to look at what was final. It's 2.5 basis points, so 0.002, I guess.
Got it.
And
Bill,
then 0.2 on the top line. Sure, yeah.
Okay, I have a question. Bill, could you go to page 26 of the presentation? So, because we're looking for long-term projections, could you comment on that 94% of active managers do not beat the index over 20 years, and why would we possibly pay a 20% outperformance fee for an enhanced index? Which I was told that Pinebridge, when they were presented to the board, was presented as an enhanced index. That's why I'm saying that. If that's not correct, you can correct that.
No, they are a low tracking error manager. Our expectation is that their performance would be, say, plus or minus 1% of S&P 500. That's a typical expectation for them.
Okay.
So you're right, so you would think of them as enhanced index. So this conversation came about in June of 2020 because we were going back and forth with Pinebridge. We had put them on watch lists, so they came back to us and said that, and at that point, I believe we were paying them 15 or 20 basis points. So at that point, they came back to us and said that we want to offer you an attractive fee schedule, and the incentive fees of it only kicks in after they had reached that high water mark because they had been underperforming at that point. So they wanted to make it more attractive to us, and this was their way of making it attractive.
I think we were paying around 18 basis points originally, which was lower already than what they usually start this strategy at, even for commitments of like $50 million. They reduced the fees on the outset, decently, and then as again, I don't like to use the term enhanced index because it's not programmatic or rules based. It's human decisions being made, but it is a quantitative strategy, and as Surya mentioned, low tracking error. So and that being said, it's 20% on anything over the index. So there is a possibility of exceeding the index. When you have an index fund, there's really no possibility of exceeding it. So you'd only be paying on returns over that benchmark threshold. So it's only on the upside you're getting charged. Whereas as an index fund, I think Rumblind charges 1.5 basis points compared to 2 or 2.5. Now Rumblind, you're gonna match exactly. There's no upside, there's no downside. Pinebridge, there certainly is a downside. There's also an upside, and the upside is capped. Again, given the changes we've seen in the market and that everything seems to be moving as we expected it, and given again that there's still 100 basis points of return to go before that even kicks in, Fran, we think it's prudent to keep Pinebridge on at this time.
Yeah, are they, given the changes in the market, are they still a plus or minus 1% of the index tracking story? Or Alex, would that still apply to them?
Yes.
Okay.
And that came through in 2021.
Yeah, no,
we were happy to see that. Yeah.
That's fine. Okay. So you think they'll be among? You think they have a good chance of being among the 6% over a 20-year period that outperform the index? That's a trick question. That's a rhetorical question. I'm sorry. Please don't answer that. I think we all know the answer to that. I was actually bringing a little levity to the discussion. So thank you.
The hope is that if they are underperforming, then we make changes in 20 years and we get into that, the 32% in 3 years outperforming. Hopefully we kind of squeeze into that.
Sorry, if we're here making changes in 20 years, we've all done something right. I'll tell you that.
Yeah.
I just wanted to note, and this is something as I start to pay the Q4 fees, I'll be following up with Surya and Alex about. I believe the intent is to perhaps for them to provide a credit at the end of the year, but the last couple of invoices had not yet applied that lower rate. So we do need to get the credit or the follow-up with them on that. I know that was part of the fee schedule. That was part of the discussion that they agreed to, but we do need to make sure that that's, implemented, even if it's a little backwards looking. And I can follow up with, Surya and Alex after the meeting. I just wanted to, clarify that for everyone's benefit.
And we'll also clarify the fee schedule
Yep.
after the meeting. Yes.
Yep. So in light of Don's, I think, good suggestion and recommendation, if the folks from PFM wanted to briefly cover the December performance, I did just want to note real quickly, again, just being a public meeting and such, the funding percentage, I know that was referenced a few times by various folks. The funding percentage for the plan as of the last actuarial report was just over 75%, around 75.3. And then in terms of the total AUM, so as of this morning, a little under 685 million in total assets, 684.86. There's around 4.45 million in cash, and that includes the fact that we just paid our portion of benefits yesterday. So that includes the the $2.5 million decrease for benefits this month. And then with that, I'll turn it over to Alex or Surya to look at the December numbers.
Thanks, Bill. If you want to scroll up one page to the top here, there we go. So this is as of the end of the year. As Chris mentioned, 685.9 million, at the end of December. A positive return over the month, over the fourth quarter, and a very strong return for the full year 2021. On the backs of asset allocation, certainly an overweight to equities, but also active management, was a good contributor in, as we'll see in a number of these asset classes. So, jumping down the first segment, combined large cap. And, I will mostly focus on the full year numbers, if that's okay. I don't know if anyone has any objections to that. I think really the month was sort of a continuation of the year. But if you look at the full year, again, this is what in the blue bar, combined large cap. That is purely a measure of active management. That doesn't take into account any overweights or underweights outside of the asset class. So certainly being outside of bonds and having an overweight to large cap equity helped. But again, within large cap itself, for the full year 2021, the plan returned 27.73%, compared to the, Russell 1000, which is the plan benchmark for this segment, of 26.4. Excuse me. Looking at Pinebridge further down, you can see here, it's 1 month return again. So just for the month of December, up 50 basis points or so over the benchmark. That, as Surya mentioned, is what we would sort of expect to see maybe on a monthly or quarterly basis. It's probably towards the higher end. Looking at their full year returns, however, 30.38 versus 28.71 for the S&P 500. So the return to a market environment that is a little better for quant funds, and certainly Pinebridge in particular, we saw it take hold this year. Moving down slightly, the combined small cap segment. Again, active management doing a quite a good job for the full year. You can see the blue bar, 26.94% versus 14.82 for the Russell 2000. Certainly Copeland, the pure active fund, returning 27.14 for the year. Again, its returns have been volatile. I think from a month-to-month standpoint, they had shown some underperformance, in several months, but more than recouping in others. They're a fundamentally based manager. And you can see the outcome for the year there. Rumbline's small cap core, you remember this is a passive fund, but it's tracked to the S&P 600 index. You might all remember when we made that decision or recommendation, we noted the differences between the S&P 600 and the Russell 2000, a higher quality index. And, you know, I don't think this is typical. Maybe Surya, you know, you can maybe speak to the divergence between the 2000 and the 600, but certainly this year was a prime example, and the plan was a beneficiary of it. I don't know if there's anything you want to add on that.
No, over long terms, we do see that divergence in performance between S&P 600 and Russell 2. There would be time periods like Q1 of this year where Russell 2 would have outperformed S&P 600. Russell 2 has about 35% of non-revenue earners sitting in the benchmark. So when you have those low quality rallies, you do see Russell to do well. When you have the large momentum rallies, Russell 2000 tends to do well. But S&P 600 is 600 smaller cap companies that have either positive earnings for the last, it's a combination of positive earnings for last quarter and positive earnings for cumulative of the last 4 quarters. So that's how they look at earnings. And as a result, you do not have the non-revenue earners sitting in S&P 600. And as a result, you're able to get a higher quality, smaller cap portfolio. There would be times where, as I said, you would see that divergence where Russell 2 tends to do well, but research has shown that over long term, S&P 600 does outperform Russell 2.
There was a period, I think it may have been at the beginning of this year or late last year, when the Russell 2000 was outperforming. And it coincided, interestingly, with Copeland underperformance. But anyhow, yeah. Moving on. Thank you, Surya. Moving on, international equity again. If you look at the full, you know, both for the month and the full year 2021, the blue bar, active management contributing to pretty nice outperformance, 11.18 versus 7.82 for the benchmark. Acadian, you know, certainly being a major contributor there, you know, but also Earnest as well. And Earnest, you know, has been off watch now, I think, for all of 2021, if I recall correctly. But you know, we're certainly very pleased with how the you know, that fundamental manager has performed and recovered. Moving on to the next page, you know, fixed income. And again, you know, maybe this is a little bit of a difference. I think historically in the past, a lot of the active management well, I should say, you know, a decent amount of active management contribution has come from the fixed income managers. Less so this year as opportunities have decreased, but you can still see for the full year active outperformance minus 0.66% versus the Barclays aggregate, which was down 1.55. The planned fixed income blended benchmark includes some corporates and high yield, so that's a little bit more tuned to the, you know, the asset class breakdown or the sub asset class breakdown. But when you're looking at the planned benchmark, which is the Barclays aggregate, you know, active management still delivering about, you know, close to 1 percentage point of outperformance, you know, for the full year. So, you know, again, we maintain this asset allocation, you know, slight overweight to equities. We continue to generally draw from equities. Certainly towards the end of this year, I think there was 1 month, Chris, where we did take from fixed income earlier in the fall. I can't recall exactly. Time has flown quickly here, but you know, things continue to look good. You know, it's, again, if we look based on purely on a modeling, we wouldn't see all of this. But again, when you take into account the active managers, the tactical management, and actually what happens in the markets, you know, we've been pleased with how the plan is done. So that's all I've got to say. I don't know if there are any questions. I know you guys have more stuff to talk about. So.
No, Alex, I just wanted to say this asset allocation update, the materials are very, very good and very thorough. So I think I really enjoyed reviewing them, and they were very clear and had all the relevant information. So I appreciate that. It's a very good presentation.
Thanks. And we actually have a write-up on the capital markets assumptions that goes into some of the background on them, and it's something we put out annually. We'll get that sent over.
Thank you, guys. Appreciate it.
Yeah, I'll second that from Fran, and I appreciate that, and that would be helpful, Alex, if you send over that background too. Thank you for that.
All right, so should we take off now?
Yes.
All right. Thanks, everyone. Stay well.
Thank you.
Thank you.
Thank you.
Thank you. Thank you.
All right. We had a very intense discussion on what we should do with this private debt opportunity. And I would say, and Chris, I don't know how many years I've served in my capacity. Is it 4 years, 5 years, something like that? I don't think we've had a discussion on one particular issue as intense and as long as this one, which leads me to believe that the decision makers are really struggling to get comfortable with the approach. So it appears to me that maybe the solution, and I'm going to ask you guys to comment, but maybe the solution is to hold back on making a decision on this particular investment strategy. I do recall, and Chris may want to comment on this, I do recall asking a question when we first discussed this, and the question was whether or not the city of Philadelphia was investing in these types of assets. And I think Chris told me yes. And I was just wondering, Chris, if it was yes, how has their portfolio of this type of investment, how has it performed, and are they comfortable or uncomfortable with the performance? And is it as illiquid as what we were talking about?
Sure. So I'll try to answer, all of those questions, Don, and if I miss any, just let me know. So, yes, the city of Philadelphia Pension Fund does have investments in private debt, but it is a much smaller recommended overall portion of the portfolio. So we would only be looking at a maximum of 2% of the overall plan, as opposed to if we were at, let's say, 10%. I think PFM has recommended roughly double that. It is illiquid, although slightly less illiquid than traditional private equity. Alex referenced that the average, lockup is closer to 7 to 10 years. I take a little issue with that because traditionally, most private asset firms have the right of auto renewal, so to speak. So a private equity investment, for example, that's listed as 10 years, almost always gets extended out to 12. So I would just say, I would say that the average is probably a little bit higher, I think, than he said. I don't think there's been any initial issues with performance, although I would say that our investments into private debt, at least the ones that I've been involved in, or I think the controller's office, Fran, are fairly new. They're only a couple years old. These, we've not been in these significantly for a significant length of time. And I'd also add that, I did hear some mention of leverage from Alex and Surya. One thing that we've been very, I think, prudent about at the large fund is making sure that we're comfortable when we hire a manager, whether they do or don't use leverage. So, for example, one of the managers that the board has hired, I think on 2 occasions, we have gone into an unlevered vehicle on both occasions. So that's also another important consideration in terms of, I think, the trustees' comfort level with some of these investments. Lastly, I think, as Fran, perhaps Nick, either stated or alluded to, the funding level and the liquidity needs of the two plans are very different. This plan, roughly 75% funded. The larger fund around 52% or so, give or take. So that's also another consideration. So hopefully I answered all your questions. If I didn't, let me know, but I think I covered the questions you had laid out.
Yeah, just one final question.
Sure.
Can I assume that there are benchmarks for that particular investment as well? And can I also assume that they have met or exceeded the benchmarks?
So there are benchmarks. We do have quarterly and annually private equity, which I'm lumping private debt into. You can compare them to a Wilshire benchmark. You can compare them to like an S&P plus a certain number of basis points. I'll give you a qualified yes as to whether they've met the benchmarks, only because some of those investments are so new that when you're ramping up investments, the returns are skewed in a way that makes it difficult, kind of the J curve they talk about, when you're putting money in and you haven't gotten the money back out, that you're all familiar with. I think early indications from those funds have been promising. The board has generally been pleased, but there are ways once you get fully ramped up, yes, to track versus various industry benchmarks, how your liquid assets are performing.
Chris, if I can add to that, Don, Chris is referring to relatively new investments in the area of private debt. Predating Chris are multiple investments in the area of private debt, specifically distressed debt, which truly showed to be distressed, and the returns not only trailed the benchmark, but were abysmal. And in that article I cited in the Wall Street Journal today, the one investment manager who said he sees a $40 billion industry in private debt is one of the companies that the larger fund was invested in, where the returns were catastrophic. So the private debt and distressed debt turned out to be exactly that. So while Chris is commenting on investments that were made while he's been CIO, there were previous investments made in private debt where Chris will tell you. And by the way, when we talk about not being able to get out of an investment, there are still portions of those investments that we are stuck with, and the returns are still negative from month to month, quarter to quarter, and year to year. So the larger fund's history with private debt has been mixed at best, and the more recent investments, as Chris indicated, show promise, but they are so new that we don't really know at this point. Chris, would that be accurate?
Yeah, no, and that's a very fair point. I was referring to the last, let's say, 3 to 5 years since we've revamped the asset allocation for the large fund, since we've had new consultants, some new staff members. But you're absolutely correct. Going back 10, 15 years, distressed debt and some related vehicles, be it Apollo, KKR. I mean, again, these are all public record. Avenue that were in the avenue of distressed debt, distressed either private or public debt, as Fran indicated, did not perform well, did not meet not only private debt or private equity benchmarks, but would not have even met kind of traditional government bond benchmarks. I mean, they were well below that. So that's a good point Fran makes. It's a good clarification to note that over different time periods and depending on what specific investments we're talking about, that the results have sometimes been poor to be charitable. I think that's a very fair comment on his part.
Brandon, any additional comments you want to make on where we are here before I go to Nick?
No, I think my position is pretty clear on this.
Yeah, I mean, I shared the same. I had all of the same questions that that Fran and Chris had. So I certainly think there are reasons to hold off. And Don, I like your suggestion at the moment to sort of people seem to be struggling with the decision, and I think it's because there's some real questions, and I'm in agreement with Fran. I think that this is not a decision that we need to dive into right now.
I'm on board with that. When we used to go to credit committee at Wells Fargo, and when there was difficulty reaching a positive decision, we knew that credit wasn't going to get done. So I'm with you. So is this something we need to vote on, or what's the process that we need to take? Because it seems like we want to pass on this.
I think the only thing, and I can work on this prior to the next meeting, or I should say I'll review it, is if just the IPS needs to be amended or tweaked just to drop the target or the range so that it, isn't at 7.5, it's more like 0 to 10. But in terms of a vote, no, I mean, we're not, there's no requirement to vote on Golub. There's no requirement to vote on, officially passing on any of this. I think it's fine to continue to take it under advisement, revisit it, over time, whether it's in 6 months or a year, as prudent. But no, I don't think any specific vote is mandated or required at the moment.
So let me just ask one final question. We moved in this direction, I thought, because we felt it was, at that time, we felt it was prudent. And I think we felt that the portfolio needed a certain amount of diversification.
Mm-hmm.
So does that mean that we will revisit how we can accomplish that, but maybe with a different investment vehicle? So where does that put us? I guess that's my question.
Yes, I think over the next, whether, may not be the next meeting, but certainly over the next couple meetings, we would do an annual asset allocation review and check-in. And I think, it would be prudent, as you suggest, Don, to, again, and just talk about the diversification more broadly, other options, and to talk about how we might achieve that, without the use of private debt or bank loans or some of the other things we've talked about today. So yes, that will come back to the table, during, let's call it the next 6 months, the next several meetings, to your point.
Excellent. Is there any new business that we need to discuss before we adjourn?
I don't have any, if the commissioners do, but I don't have anything for additional discussion today.
Well, if that's the case, why don't we vote to adjourn, and thank you all for participating. Excellent meeting.
John, you need a motion and a second.
I make a motion to adjourn the meeting.
And I'll second it.
And motion has been made and properly seconded. It passed. So you guys have a great day. Thank you.
Yep. Have a great week.
Thank you, everyone.
Thanks, everybody. Thanks, Chris.